What if I told you there was one investment that the world's greatest investor recommends for almost everyone that has returned around 1,800% in the last 30 years, that costs as little as $1.50 per year on a $10,000 investment, and that you can start with as little as $1 today? It exists. It's called an index fund. And by the end of this video, you'll understand exactly what it is, how it works, and how to get started. Let's start with an honest question. If you wanted to invest in the stock market, which stocks would you pick? Apple? Tesla? Amazon? Here's the uncomfortable truth. Even professional fund managers, people with Harvard MBAs, billion-dollar research budgets, and decades of experience, get this wrong most of the time. In fact, fewer than 15% of large-cap fund managers beat the S&P 500 over the last decade. 15%. That means 85% of the professionals lost to the market average. So if the experts are failing, what chance does a beginner have picking individual stocks? That's exactly the problem index funds solve. An index fund is simply a fund that owns a little bit of every company in an index. Let's use the S&P 500 as an example. The S&P 500 is a list of the 500 largest publicly traded companies in the U.S. Apple, Microsoft, Amazon, Nvidia, Alphabet, JP Morgan, all of them. An S&P 500 index fund buys a small piece of every single one of those 500 companies. When you invest in that fund, you instantly own a tiny slice of all 500. You're not betting on one company. You're betting on the entire U.S. economy. And here's the key thing. Nobody is sitting there deciding which stocks to pick. It's done automatically by an algorithm that simply tracks the index. No guessing, no opinions, no mistakes, just the market. Now let's talk about what this actually means for your money. The S&P 500 has returned about 10% per year on average over the long run. That might not sound dramatic, but compounding makes it extraordinary. $10,000 invested in the S&P 500 30 years ago would be worth about $187,000 today. The same $10,000 in a savings account? Maybe $15,000 at best. And here's something even more powerful. You don't need a lump sum to start. If you invested just $400 per month into an S&P 500 index fund and left it alone for 30 years, at the historical average return, you'd end up with over $835,000. $400 a month, 30 years. No stock picking required. That's the power of index funds. Here's another reason index funds win. They're almost free to own. When you hire a fund manager to pick stocks for you, you pay for their salary, their research team, their office. That cost gets passed to you as a fee called an expense ratio. Actively managed funds typically charge 1 to 2% per year. On a $100,000 portfolio, that's $1,000 to $2,000 every single year. Gone, whether they beat the market or not. Index funds are different. Because no one is actively picking stocks, the costs collapse to almost nothing. Here are the three most popular options right now for U.S. investors. The Fidelity 500 Index Fund charges just 0.015%. That's $1.50 on a $10,000 investment per year. No minimum investment required. The Schwab S&P 500 Index Fund charges 0.02%, $2 per year on $10,000. Also, no minimum. The Vanguard S&P 500 ETF charges 0.03%, $3 per year on $10,000. $3,000 minimum to start. Any of these three will do the job. The difference between them is essentially a few dollars a year. Now, here's the part that should make you feel genuinely good about this. Warren Buffett, widely considered the greatest investor in history, has said this publicly, repeatedly, for decades. For most people, the best thing to do is to own the S&P 500 index fund.
I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
Not because he couldn't pick stocks. He's clearly one of the best who ever lived. But because he understands that for most people who have jobs, families, and limited time, trying to beat the market is a losing game. He even put it in writing. In his letter to Berkshire Hathaway shareholders, Buffett specified that after his death, 90% of his wife's inheritance should go into a low-cost S&P 500 index fund. The world's greatest investor, recommending the simplest possible approach for most people. That's not a coincidence. Now for the honest part. Index funds are not magic. They follow the market, up and down. When the market drops 30%, your index fund drops 30%. The key is this: you only lose if you sell. Every time the market has crashed in history, it is recovered. And the S&P 500 has never produced a negative return over any 15-year period since it launched in 1957. Never. Not once. The biggest mistake beginners make? They panic and sell when the market falls. They lock in their losses, and they miss the recovery. The right move is to do nothing. Keep investing, keep holding, and let time do the work. So here's where you are right now. You understand the stock market. You understand why individual stock picking is a losing game for most people. And now you understand index funds, the simplest, most proven way to participate in the market's long-term growth. Every week on this channel, we break down one money concept. Clearly, honestly, no jargon. If this video helped you understand something your bank or school never taught you, hit subscribe. That's exactly what we're here for. And drop a comment below. Are you Team Fidelity, Schwab, or Vanguard? I read every single one.